With pre-tax, you get an income tax break today. Your contribution lowers your taxable income now. But when you take the money out in retirement, you pay income taxes on it then. With Roth, it's the opposite. You pay the income tax today, but your money grows tax deferred, and qualified withdrawals in retirement are totally tax free, including all the compounded growth. The government limits how much people can contribute to tax advantaged retirement accounts each year. Workers age 50 and older are allowed to contribute additional amounts called catch up contributions to help them save more as they get closer to retirement. So here's the change you need to know about. Starting in 2026, if you make catch up contributions to a 401k, 403b, or 457b plan, and you earned more than about $150,000 in the prior year, 2025, and that's going to be indexed for inflation going forward, those catch-up contributions must go into Roth. That means they must be contributed after tax, not pre-tax. But let's pause here because that $150,000 is not based on the income number most people think about. Most tax rules are based on adjusted gross income. Some use modified adjusted gross income. This rule uses neither. It uses FICA wages. You can find your FICA wages on your W-2, or typically like your last paycheck usually shows your year-to-date earnings, which is a good starting point. If you made more than $150,000 in 2025, congratulations, you're a high earner. It simply means your catch-up contributions to your employer-sponsored retirement plan must be Roth dollars starting in 2026. I know this is new and a bit technical, and if you're feeling confused or overwhelmed right now, pause the video. One practical effect of this change is that if you're used to making pre-tax catch-up contributions, your paycheck may be slightly smaller because those contributions are now taxed. But when you withdraw that money in retirement, both the contributions and the growth are tax-free. For someone in the 22% tax bracket, this equates to about $1,650 more in income tax this year. And again, all of that growth comes out tax-free later. Having both Roth and pre-tax buckets gives you more flexibility when it comes time to plan withdrawals in retirement. At Breakthrough Financial Wellness, we want to help you prepare for this change, both financially and psychologically. No one enjoys seeing their take-home pay go down, but when you frame it as a trade-off, paying some taxes now in exchange for lower taxes later, it can help settle your nervous system. Fewer options now for more options later. That's often how it goes.